what's your overview of the market? I can also see that this rally back is driven by the tech stocks. So should we still be patient and cautious about the market conditions, or can we say that was a just sell off, now it's reversal point? So we're wondering your overview of what's happening in the market.
Yeah, I still think that I still think that we are not out of the woods. Historically, the end of August into September and October are usually lean months for the market, especially during election years. I'm not so convinced here. This week was an option expiration week, and they are usually always buyers on balance, especially in the beginning and middle parts of the week, where the market tends to firm up and they tend to put money to work. Then you tend to want to unwind those positions, some of those positions, a percentage of those positions during the interior parts of the week. And it happens almost every time. They look for an excuse because everybody's a gambler in this game. So it's no different whether you're a retail and a small account or whether you're an institutional deep pocketed. It's all the same. It's all relative. They still have a decision to make. Now, having said all of that, the retail sales numbers that came out yesterday morning, Wednesday or yesterday, really catapulted the market. Don't ask me why. Okay, I really don't know why, and there is no plausible reason why. But we spoke about this during these interviews a number of times, and the news means less and less with these numbers because the hedge positions are so diverse in nature that coming out of these positions have different meanings for everybody's position. So even if you knew what the numbers were before they came out, you could not predict what would go on because everybody's bias is relative to their own positions, and their positions are not 100 shares, and their positions are not 100,000 shares. They're in a million, multi-millions and millions of shares of position hedged that they need to come out of. So if somebody's looking for a good number, and a number is whatever it is, but another group comes out of this having to sell the market to unwind. Yes, sell and unwind. Well, another group is there to buy to unwind. So it just balances out the numbers. Usually, but in general, the first move on any of these big news days like CPI or FOMC days, which are really volatile trading sessions, the first move is usually always the wrong move. Okay, all right. I'd like to call them criminals out there, and I don't suggest that there are criminals out there, but there are criminals, and all I mean by that are groups of investors who have a bias and want to try to trick you, and the algorithms are great at that. That's a perfect example of criminal activity, as I call it. Is the algorithms. They want to say, the numbers come out, and what is the narrative? The narrative is what the numbers say. How many investors follow what the numbers say based on the direction of the numbers? So it's all wacky at this point, but it's good to understand what I just said. It really is good to understand it. But so the retail numbers come out. And I will say this about the retail numbers. The retail numbers were stronger than anticipated, but, a mother always said, read the fine print. And the fine print is that, ironically or crazy as it may seem, the wealthy investors, the wealthy people in the retail report were buying. So the wealthy people were buying at a discount. Now, the normal people who run the economy, okay, well, their credit cards, they're the highest delinquency rate, and the debt is as high as it's ever been. The debt. Why? Because for months they talk about the turning of the economy around, and everything's going to be fun and games and loosey-goosey and la, 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 and it's all going to be good. So that prompted the normal people to keep building up their credit card balances. Okay, and it's all based on hope. Well, guess what? Inflation didn't go down. You're still paying 30% higher for eggs and other goods. It's all in that range. Gasoline, eggs, all the staples, rent, all the staples that we live by. And so now these people are in debt above their head. And, they're not sinking yet, but, go pay one of these credit card companies an average of 23.99%. Oh, yeah, here's your bill. You owe us $1,100 or $900, and pay the fee of $40. Oh, that's great. And now you're paying a vig of $23.99, on the balance every month. And if they give you a cash credit line and you tap that, that's just under 30%. So, I mean, you get better rates from a wise guy in a Brooklyn neighborhood, if you will, or Queens neighborhood, like I grew up, to borrow money. Okay, so these kind of rates are just absurd. This is going to get to the people. It's going to get to the people. I'm in a camp that there will be a recession. I just am. So I hope that answers that long answers your question.
Definitely, that was a large weave. Also, I wonder your opinion on the yen carry trade. So if I'm not mistaken, next week we will have inflation data release from our Japanese markets. I don't know if you're following, and what's your opinion? How can it reflect? I mean, if they're expecting high inflations, that will affect the yen carry trade. So maybe we should be more cautious on that.
Yeah, I think that's a good question. The market started the last downturn a week or so, 2 weeks, within 2 weeks anyway, ago, started the downturn, and what started it was the Japanese yen, and the Japanese yen was called what they call the carry trade, and what the carry trade is they borrow against the value of the yen and use it to buy Magnificent Seven stocks. Mm-hmm. Well, what happened? Like every other year, like every other situation that goes on with margin calls, the Japanese yen tanked. Japanese yen went down significantly, causing margin calls, meaning they had to sell what they used the money for. They had it leaned against the Japanese yen. And then they got margin calls, and that started the balloon effect, the snowball effect, if you will, on the Magnificent Seven stocks, which really pushed the downside of that market. And it was responsible. That was responsible.
Today, we will discuss about index divergence. The person suggested this topic. I think he is not in the room. We will ask this man next week, maybe. If we kick off with the first question, how do you identify index divergence and why it's considered a significant signal in technical analysis?
For day trading, divergence is the whole thing. For instance, this morning, I may not take a lot of trades prior to the opening, but there are plenty of opportunities, but you just got to be selective. But what I do look for at 8 o'clock and do search for are divergences, are patterns that the market is setting up early. And when the patterns are setting up early and they stay consistent for an hour or so, it usually will roll over into the opening and maybe stay consistent for an hour, 2 hours, 3 hours, maybe the whole day. But it's all defined early in the morning. It shows the investors show their hand early in the morning. It's a skeleton crew, if you will, of investors relative to what's there after the opening, but it still gives you an indication of the patterns that are setting up. And the patterns that I look for, including before it's set up, is the divergence patterns. This morning, something very valuable I identified early, and that was the fact that the future, the YM, the dirty Dow, as I call it, future market was leading the nasty NASDAQ. Okay, so when the YM future contract, and you listen, I trade the future market, but it doesn't matter. This has an incredible effect on equities. Okay,
it's the perspective, yeah.
So I look for the divergence, especially all day. But in the morning, when it shows you that pattern, sometimes that pattern holds up most of the day. Maybe more, maybe less, I don't know. But you could see, and I could see, and I pride myself in being able to see before it happens. So having identified a pattern this morning made me a good amount of money and made my session people a good amount of money because I was able to see. So what does that mean? It means a number of times this morning, and go look it out in your charts, anybody, whoever's here, go look at these charts this morning after the opening, before the opening, you will see all of a sudden, YM is up near the top of a technical area. NASDAQ comes down, NASDAQ comes down, NASDAQ comes down, YM stays up. That's divergence right there. What does it mean? It means you could buy the NASDAQ. That's what it means. There's the divergence. So if you buy the NASDAQ futures, or you buy NVIDIA or Apple or any of the other Magnificent Seven stocks, you can make the same trade. So YM stayed up, comes off a little bit, doesn't go down, stays up there near the top of the range. NASDAQ creeps up. YM ain't moving, NASDAQ long. That's it. And that's divergence. How do I look at the divergence? I look at the divergence by technicals. I look at divergence by, I have 3 charts next to each other on a 127-inch monitor, a 1-minute NQ, YM, and ES charts next to each other, overlaid by technical areas, usually Keltner technical areas, 21-day, 200-day moving average, 9 EMA, and the volume weighted average. And you could see the divergence taking place. Look, folks, the market is built on hope.
Are you checking the divergence in between same indexes, or are you implementing this strategy to find out some opportunities for trading as well?
Divergences are the name of the game. Mm-hmm. If you identify divergences, you can use them any number of ways. Okay. I didn't have to buy the NASDAQ right there. Mm-hmm. I could buy the NASDAQ, or I could short the YM. Mm-hmm. So it's the balance, man. It's the balance. And sometimes I will set up an arbitrage. If I see big divergence right there, like that, mm-hmm. I know they're probably going to go in the other direction from one another. Mm-hmm. So I could short the YM and buy the NASDAQ. I like that. And scrap out money. Mm-hmm. As they come to balance one another.
Got it. Yeah, that's a good strategy to know. And what types of divergence are most critical to watch, you think?
What type of divergence? What?
Most critical to watch.
Again, I have those 1-minute charts. That's one minute. So they're going to move quicker. I also have 3-minute charts, mm-hmm. the same vehicles. The 3-minute charts, the 1-minute chart will give you a little bit of a head start on the direction. The 3-minute chart is much more consistent. And the 3-minute chart is my favorite chart. It really does set up to be the final decision maker to me, the 3-minute chart. And so when I see that 3-minute chart, if I see that 3-minute chart divergent down with the YM holding up, and the NASDAQ comes down to a lower 3-minute Keltner channel, bottom support area, and YM is holding up, steady as she goes. I know NQ is probably going to catch up. Mm-hmm. If there's no weakness in that divergence, if there's no weakness in a YM, I know NQ is going up.
You got it. All right. Thanks for that. My next question is, Richie, How do you use index divergence in conjunction with other technical indicators to confirm market trends?
Well, that's a good question. Okay, so I don't want to repeat exactly what I just said, but remember what I just said. Now I have a trading view charts, and trading view charts identify the discount and premium areas. It also discounts the gaps that are left. Market comes up, market comes up, market comes up, all of a sudden shoots up. Well, over here is going to be a gap.
Yeah.
The algorithms have never seen a gap that they don't like, you see. So the market goes up, market's up, it's left a gap. As soon as the market starts getting weaker, as soon as the market is full, it's finished with its run up and it starts to come down, the algorithms smell blood like a wounded animal. And where is it going to go? They're going to the gap, man. Yeah. That's where they're going to go.
The gaps are always being filled.
The gaps always get filled. I don't care. The gaps always get filled. And either way, doesn't matter. Gap up, premium area, discount area. And to further embellish that point, you come down to a discount area in a discount window near a technical support area. I look for expansion going down through that area. What is expansion? Expansion is the people who are ready to abandon ship. The expansion is the algorithms trying to push those people off of the ledge. Why do they do that? Very simple. They want to clear the way up above. Yeah. They want no supply up above to do what they do.
Got it.
So,
I hope that yep. Yeah, that was. Also, I would like to remind the people in the room, if you have questions, please don't hesitate to share with us on the chat. Richie is always happy to answer them. We are trying to make these sessions interactive as much as possible. So my next question is, Richie, what are the risks relying solely on index divergence and how we can mitigate those risks?
You know, if you can read divergence, you already have a leg up. Because if you can read divergence, the way you could be wrong in divergence is being too early or too late. It's all about the entry level for divergence. But once you pick off the area, and once you identify the pattern that you want shown to you by divergence, you need to have some buying power. Because if you're early, you cannot set up a divergence pattern play by a single entry. You need to be able to add to that position if you're early or late. And you don't, and I never ever lump together positions. I always give it enough room. If I'm long, I want to be long lower so I can bring my cost down. Yeah. And vice versa. So, the divergence will identify that kind of stuff, but don't rely on a single entry to try to mitigate or beat that way of trading. Mm-hmm. You need to have a little buying power, and that could be said about anything you're doing in a market. You don't want to
spend all your eggs.
Yeah, you don't want to put your eggs in one basket with a single entry execution. You just don't. You're not going to get a true sense of your abilities to trade. Put it that way.
Yeah, thanks for that, Richie. Next question is, how does index divergence behave differently in different type of market conditions, such as strong uptrends versus sideways?
Yeah, I mean, actually, market conditions really don't matter. Okay. If the divergence is there, you are going to be successful. If the divergence is there, and your entry is able to be in the right area without being too far off, and you're able to have additional ammunition to add in case you are it doesn't matter what the conditions are. I mean, if it's a wild, emotional market, that's a little different. You know, you got to be a little more cautious with that, of course. All right. But, and that even really doesn't matter because at some point, everything calms down. So to be able to read, you know, it really doesn't matter. That's the answer to your question. As far as the type of market it is, divergence is divergence. Once again, if you can master picking off where the divergence lies according to your style, you're going to be successful.
Yeah, thanks for that, Richie. We're coming end of our time for today. There's no questions on the chat I can see. Can you give us a wrap up of today, and we can end with your golden nuggets final thoughts of the session, Richie?
Yeah, I mean, today here we have a market that's really, they lost their minds Wednesday and Thursday, as far as I'm concerned. They are way ahead of themselves here. That's my opinion. I don't, you know, you have to have an opinion on the stock market. I don't care if you're day trading or what you're doing. You need to have opinion, and you need to have a macro look at what the hell is going on in the world to help form your opinion of the stock market. It helps guide your investment, help guide your trading. Again, whether you're day trading, no matter what you're doing, swing trading, it doesn't really matter. All right. I'm not enamored with this, with the retail sales pushing the market yesterday, because I've identified that this is deep-pocketed, wealthy type people, whatever wealthy type people mean in this environment, I don't even know. But people that, let's put it this way, don't usually go to Target and Walmart. Okay, let's put it that way. I think that's a fair way of putting it. So it doesn't really affect the people that control the economy, and that's the middle class. Doesn't affect them. Make no mistake about it. The middle class is getting destroyed here, and it's not going to get better. It's not going to get better because wages are not going up. Inflation is not going down. Okay, so, you know, you could be looking at an environment where inflation stays the way it is, and people walk away from the market. People walk away from, you know, spending. And that is a dreaded word called stagflation. And if that happens, you could run for the hills. The next thing I'll caution everybody is in September, the next Fed meeting on interest rates, I mean, it looks like a virtual lock that they will reduce interest rates by 25 basis points. If that's the case, market will probably go down, but, you know, if that's the case, market will probably have a knee-jerk reaction down to that. But I will caution everybody, and I'll leave you with this note. If the Fed panics here and cuts interest rates 50 basis points, you could run for the exits, because to me, you see, the Fed, when they're putting these numbers out there, we're looking at the numbers that the government is putting out, but the Fed has other numbers that they know. Okay, so if they're cutting 50 basis points when everybody's expecting 25 basis points, it's not good. And they will hurt the market with that.